Since July of 2021, PayPal stock has dropped by a considerable amount. It's fallen from $300.50 all the way down to the current share price of $58.25. So what does that mean for us value investors? Well, in today's video, folks, I'm going to investigate PayPal, see what they're doing right and what they're doing wrong, and see if we can capitalize on this crazy price drop, because I think it's a great business and the stock price is probably trading undervalued. But let's see what the whole story is by jumping into the video. And for those who are new here, my name is Leo. I'm a value investor. Let's see what this company is doing right and what they're doing wrong. So without further ado, I'm going to jump into PayPal here by showing you the stock spec software. So here's the price drop. Now we're currently at 58.25, as I said. But look at the swing in price to earnings ratio. On average, PayPal's price to earnings ratio was sitting at 50-50. Currently, we're sitting at 15.88. So that is a huge drop in price earnings ratio. Now, that's one of the first metrics that I like to look at, just to see, okay, like, what is the company actually bringing to the table? And you can kind of get a very rough feel if you're overpaying for those earnings. But if I just hop over to Yahoo Finance for a quick second and looking at the earnings over the last four quarters, if you will, from 2022, we beat the earnings, we beat earnings, we beat earnings, we met earnings, and now the next earnings are coming up in November 1st. So what I'm seeing right off the top is that we have a company that's currently been beaten down, but they've been beating earnings quarter after quarter. Here's the thing, from a financial strength perspective, over the last 5 years, this is what the software grades the company on. They're getting a score of 7 out of 10. Now that's pretty good. They're only getting docked in 3 different categories. One being the price to earnings ratio sitting extremely high at $50 and 50.50. Their current ratio is sitting below 1.5 at 1.30. And their debt to equity ratio is sitting above 50%. So what does that indicate to us? So as I mentioned earlier, the price to earnings ratio kind of shows that if you were buying this company prior, you may be paying a premium for it based off their earnings. The current ratio shows how much liquidity the company has in terms of paying off their liabilities with the assets. So in a high interest environment, which we are currently in, are they able to, let's say, if push comes to shove, shit hits the fan, can they cover those liabilities? And PayPal can do that. They can do that no problem. They just won't have as much liabilities left over, where the software likes to prefer a decent margin of safety in that regard, 0.5 to be exact. So 1.5 and higher is where the software likes to award a point to the said company. Now, the other point that they're losing a point in, or the other category that they're losing a point in, is their debt to equity ratio. It's currently sitting at 51.38. Now, what does that indicate to us? That means that they're funneling a lot of their operations through debt and not through equity. So for those who are wondering, it's obviously sometimes a company might issue more shares and fund operations that way, or take on debt. So they are just slightly over that 50% threshold that we're looking for. However, with those 3 things getting knocked off, they are sitting pretty well in a lot of other categories. One being the return on equity, sitting at 16% on average. Now, that means it's pretty solid. We like to find companies that have a stable return on equity and have that return on equity be above 15%. This is the number that Warren Buffett likes to stick to, and I think Warren Buffett is ultimately a very successful investor, as we all know. So them sitting above 15% and sitting around 16% is pretty great. Their EPS growth is also up by 110%. So if you've been holding this company, you'd be very impressed with those numerics. Along with, they've been buying back shares. Now this is a double-edged sword. I'm a huge fan of companies that buy back shares, because ultimately they're shrinking the amount of the pie of that essentially that you own. So you are owning more of the company rather than diluting shareholders, where essentially you're earning less because now your share is smaller. But the only gripe I have with this category is that if they've been buying back shares when share prices were extremely high, let's say, well, any price above where we currently are, let's say if they were buying in the $200 range or all on the way down, that is not an efficient use of their free cash flow. So that's something to just to keep in mind, folks. It's great to see they're shrinking the pie, but allocating free cash flow to something like that where the share price has been extremely high, not so great. If they were doing that now, this would be the time to be buying back shares where share prices are depressed and extremely low. Now, apart from that, they have also been growing their net income. The free cash flow has gone up. The return on invested capital is sitting above 10%, which is phenomenal to see, along with the revenue growth also increasing. So here's the thing with this company, folks. We see this massive climb up of this company hitting $300 and going all the way back down. And then if you go over to the balance sheet, here's where things get interesting. You see their, hold on, no, balance sheets. I want to see the income statement. Sorry. You go into the revenue, we can go on an annual basis, and going as far back as 2013, you're seeing the revenues go up and for just progressively just go on a linear path and continue to go up. And it's obviously evident in the earnings that they've been brought forward. They've been beating the earnings, so their overall revenue's gone up. And even comparing that to the free cash flow, just to see what that's all about on an annual basis, we're seeing the free cash flow also increase as far back as 2013 from 1.6 billion to 1.73, climbing all the way up to 5.11 billion in 2022. Okay, 2022, everything's going up, but stock prices have been shooting down. So as we can see here, folks, it's pretty evident that there is a huge disconnect in the business. It's almost as if as the business was getting better, the stock price was getting worse. There's an old saying where in the short term, stocks are a voting machine. In the long term, they are a weighing machine. And ultimately, the stock price will eventually follow what the business is doing. So if the business is doing extremely well, the stock price will follow that. And if it's doing extremely poor, obviously the opposite is true. If you bought at any point in 2021, you are paying through the nose for this business. I'm not saying it's a bad company, but you are overpaying for those earnings. Now, let's take a look at the other fine details. We have a Piotrowski score of 6 out of 9. 9 is the highest score you could potentially get or possibly get. And we like to find companies between 7 and 9. That just means that over the last year, have they been making improvements on the return on assets and a lot of other different categories. And 6 is a pretty mediocre score. It's not the worst. And along with the Altman Z score sitting at 1.88, that means that for us, here's something to keep in mind, folks. Any score above 3 means that a company is in a safe zone. That means that they have no risk or very minimal risk of going bankrupt. And below 1.8, that means the company is at risk. Now, from 1.8 to above 3, you are looking at companies that are in this gray zone. Are they at risk of going bankrupt? And currently, PayPal is in this gray zone. Now, with all these other things going well for them, I can't see them potentially going bankrupt anytime soon. And we're going to go and just check out their debt scenario. Okay, folks, so here's something to keep in mind. Their long-term debt currently is sitting at 10.42 billion. Now, how does that affect the company? Well, on average, their free cash flow, let's take a look at that real quick. I'm going to pull up the stock specs page again. It's currently sitting at 4.8 billion. If we want, let's round this up to 5. So in 1 year, if they allocated all their free cash flow for that given year, they can cover around half their debt. Now, if they did a more conservative approach, let's say they did $2.5 billion of the free cash flow, they could essentially pay off all their long-term debt in about 4 years, maybe four and a bit, because it's let's say it's called 10.5. So it's not the worst debt scenario. Just something to keep in mind that obviously they're carrying around this much debt. They have half of that in free cash flow, but as I said, their free cash flow is also going up every single year. So if that continues to grow over the next how many years, let's say 10 years, and they're able to maintain their debt levels, this will be easily paid off. So something to not worry about if you are concerned about bankruptcy, given that the score for the Altman Z is 1.88. Now, what should we be paying for PayPal today? Now, that's something to also take a look at. Luckily, this software that I'm using also has an intrinsic value calculator. labeled in the price analysis section, and we're able to forecast out from 1 to 20 years based on what we believe the company might be doing. And I'm going to use the historic numbers here. This is what the company's done over the last 1 to 5 and 10 years. And I plunged in some numbers into these boxes. And if you're enjoying the video so far, folks, before we jump into the last little bit, hit that like button and subscribe button. It means a lot to me and the channel. Now, what I've done here, folks, was use a lot of the historic numbers to try to guesstimate on a conservative basis what I believe the company might be able to perform over the next 10 years. The company is currently a $63 billion, let's call it $64 billion company. So based off their 1 year growth numbers, I kind of stuck within these numbers here because they're the lowest of the bunch. So I did 7.5, 8, and 8.5. Similar thing with profit margin, similar thing with free cash flow margin, to try to see what that might look like going forward. I stayed conservative with my price to free cash flow, conservative with my price to earnings ratio, and I'm going to put a desired return of 13%, as I always do. I'm going to hit calculate, and we're going to see where we end up. So what the software is going to do is crunch all these numbers. And like I said, folks, if you want to get your hands on the software, 7-day free trial, follow the links in the description box below. There's 10 years of financial data, this amazing stock spec page to quickly analyze the company, and take a look at this. Current price is $58.50, and the average calculation comes out to be $89.17. We're hitting green across the board here, and most importantly, we're hitting green on our conservative categories. So a slower growth rate, a lower profit margin, a lower free cash flow margin with a conservative price to free cash flow and a conservative price to earnings ratio, 13% return. The conservative average is $75.25. So currently you're getting this company ideally for a really good price. And the point of this video, folks, is when you see companies hit 52-week lows, and this is why I haven't analyzed this business such a long time, but now that I've seen the company drop down by such a huge amount, this is where opportunities arise. Because look, I've always thought PayPal was a great business. However, you asked me a couple of years ago what I should be paying for this company, and then I'm going to tell you, definitely not $300. I like the business. I don't like it that much. Now, when you compress and suppress that price down to the point where we are now here's where things get a lot interesting, because now we're sitting at $89 on average for this business, and you're able to pick that up for $58.50. So if you were trying to build a further position into PayPal and you were holding the bag from all the way back when, this would be potentially a great time for you to probably double in. Obviously, this is just my opinion. Obviously, don't take it as financial advice. But for someone like me who's potentially wanting to build a position in this company, now, for me, this makes a lot of sense. And I'm loving that it's hitting those conservative averages. Now, here's what I want to also figure out is how low can I potentially go? Let's say if I did 6% revenue growth, 6.5 and 7 on the high side, like really compress those numbers to say, listen, this company's going to have the same profit margin and free cash flow margin, but what can we do with those revenue growth numbers? And we're currently still getting green across the board. So with those suppressed numbers, with a decent margin of safety, it's still trading below what it's currently trading at. That was a lot of. So it's currently trading below what you can possibly get this company for. $58 compared to $77 of what it's currently worth. It may be time to open up a position in PayPal, given the fact that they've been beating the earnings, revenue's going up, their debt is pretty manageable, and numerically they are pretty strong. The only problem is their debt to equity, their price to earnings ratio on average being a little bit high, but now it's currently sitting at 15, which is a huge discount, and the current ratio is sitting at 1.3. For me, I'm pretty lenient on that. I can afford to have it sit around just above 1. But there's so many other great things on the board that I think just trump it anyways, and I can overlook that no problem. So, folks, if you found this video helpful, hit that like button and subscribe button, and we'll see you in the next one. PayPal looking pretty solid. There's still some more work to be done, but based off the numbers here, I'm liking this. And with that being said, Make sure you grab the stock spec software. Follow the links in the description box below so you can quickly analyze companies without waiting for me to put out a video. Quickly and effectively. Look, what is it, 10 minutes into the video, and you already know exactly what you need to know about this business and that it's under or overvalued. I will see you in the next one. Thank you so much for watching.